Hello everyone, my name is Hughes Bruce, and today I'll be talking about media and its effects on the stock market. I'll be going over two types of media: newspapers, which could include the Wall Street Journal and the New York Times, and also the internet, but more specifically social media, which includes Twitter and Facebook. And the scope of this topic is the 21st century. And so here's a quick timeline about the history of the stock market in the 21st century. So in 2000, there was the tech bubble burst, which happened with the founding of several new internet-based companies. They were rapidly increasing stock prices, and too much confidence in profits drove the prices too high, which caused the bubble to burst. In 2001, there was 9/11, which was detrimental to the economy, which it caused 40 billion in insurance losses, and the stock exchange was canceled for a week after the event. In 2002, the market crashed. The stock continued to slide since 9/11 and reached a low not reached since 1997 and 1998. And then in 2008, there was the housing crash. There was a huge drop in home prices caused by bad mortgages. And in 2009, there was the Great Recession, which the housing crash was a large contributor to. And there was a general economic decline and worst recession since World War II. So social media and newspapers are the best option for analyzing media's effects because they are a major way stock prices and news are revealed to people. So people post about things or tweet about things or press releases about certain events and trends, and this can cause people to change their trading habits, and it causes emotional changes, which can change the way they buy and sell stocks. Okay, with newspapers, press reports can affect investors' emotions. So there's a certain trend with people's mood and their predictions about the future. So if it's a positive press report, then they tend to buy more, and if it's negative, they tend to sell more. So pleasant words are obviously positive, and unpleasant are negative. And events can be seen as either opportunities or threats, depending on how they're worded, which could overall increase their buying or increase their selling. And also, pleasant mood makes to more risk-taking behavior, whereas unpleasant mood tends to have less risk-taking behavior, which could lead to lower returns. The effects are even more pronounced during times of crisis. So with social media, it's more so with Twitter than with Facebook. But there is a dependence between Twitter views and stock price returns. So the stock market is greatly influenced by views and opinion on Twitter. The Bolin algorithm, which is basically a computer algorithm with around 9.7 tweets, analyzed that it tried to predict the stock market based on those tweets, and it did so with an 87.6% accuracy, which is just pretty amazing. And then WiseWindow, which is a company that uses data and in real time for business intelligence found that there's a near direct correlation between social media conversations and stock price. And then Carl Icahn, which he was basically he's an investor, and he sent a tweet that rose the stock price of Apple by almost 5%. Okay, and here's a YouTube video that shows the effects of social media on the stock market.
Now, as the CEO of the company, yeah, that's why they have these things called like Reg D, Reg F, all these kind of things that you're not allowed to do any stuff. But whatever. Really exciting announcement coming out Thursday. Now he'll never do this again because he was kind of read the Riot Act, but since he's an all-star, they let him slide.
Read the Riot Act.
Huh?
Read the Riot Act. There was no fine. There was no retribution. There was no nothing.
I'm gonna put my money where my mouth is in a major way. So in 15 minutes, the stock was up $111 million, or the equivalent of $1 million per character. This is back whenever, you know.
Okay, so as you can see, one tweet can be very influential on the stock price of a company. Alright, and here's a graph that shows the effect of public sentiment on Twitter versus Facebook stock price. So in the beginning, you can see that the public sentiment goes negative, and then 25 minutes later, the stock starts to decline. And then when it recovers, the stock rebounds about 8 minutes after that. And then the sentiment begins to decline again, and then bounces back. And then about 4 minutes later, the stock declines, then bounces back. And then sharp end of the day, sentiment drop. And then 10 minutes later, the stock declines sharp towards the end of the day. So you can see with this example, the Facebook stock price is very dependent on sentiment on Twitter. So that can be useful in, depending or predicting stock price for everyone. Okay, so some of the good things about media's involvement in the stock market is that there's more real-time knowledge on companies. You can discover trends faster. It's easier to share information and knowledge between people and everyone. And then networking between investors and people is easier, which in turn grows the market as a whole. And then some negatives about media's involvement. It taps into emotion, which can be manipulated. And then it's also vulnerable to false information because anyone can post anything. And here's some references.